September does have a reputation of being not very kind to the equity markets, and we've definitely been living that as investors. Of course, the key question is, what lies ahead? Does all this volatility present any opportunities for us on a certain timeline? Michael Craig, head of asset allocation at TD Asset Management, joins us now. Great to have you back on the program. Let's start there. I mean, there's been a tough year. It's been a tough September. Volatility, we're often sometimes told, can present opportunity. How do we see it?
It's a very challenging backdrop right now. Equities have really repriced as a function of the cost of money. So when you think about them relative to what governments are borrowing at, they've come down, but probably not as much as they probably need to. On the fixed income side, for 12 years, investors have really been challenged finding sources of income. And I think, I read earlier, we've gone from there is no alternative to now there is plenty of alternatives. And so for investors thinking about what they're trying to achieve now, I mean, we are at more attractive levels, particularly in the income space, to think about that. So that's kind of where, the thought process is now, is that I think the bond sell-off is well entrenched. Levels of real interest rate, bonds minus implied inflation, are at very high levels that typically can break an economy or put them into recession. And so, that area, I think it is a bit more interesting than perhaps the equity markets.
Now, as we get interested in some of these areas of the market, of course, people will always want some sort of crystal ball to tell them exactly when to make their move. We know we can't time the market with any great efficiency whatsoever. Is it one of those scenarios where, while things look interesting, things could still be tough for a little while?
So for 12 years, we've almost had this Pavlovian response in markets where you had easier every time we had these bouts of volatility, we've had easier policy, pushing the cost of money, quantitative easing, et cetera. And so the reaction of a lot of investors is to buy the dip. I would be very cautious with that, in a sense that combination is not likely to come anytime soon, and so you are buying into what likely will be a recession. And so I would urge patience. I don't think people are always worried about missing it. I think a bit of patience probably makes some sense, as this bear market that we're in, and we are now technically in a bear market, will likely be one that's defined more by time than by the speed of the sell-off, right? So we're probably for a longer period of a bear market than what we've really experienced for a long period of time.
Of course, in the summer when we had that rally, it seemed to be a bit of doubt among investors that the Fed was serious, and then Jackson Hole seemed to change that. It's like, well, Jerome Powell actually is serious about all this. At some point, is there an argument to be made that the Fed gets the job done, and then eventually there'll be rate cuts? I mean, investors, that seemed to be the hope that was being clung to in the summer, and then just got thrown out with Jackson Hole.
It will happen. It will happen, and I would say there's a high degree of certainty about that. But again, it's too early. They have moved from being kind of a forward-looking central bank to really be targeting measures that tend to be lagging, which is a bit tricky because forward-looking measures of inflation have rolled, prices paid, producer price indices are coming off. You're seeing a lot of the transportation measures start to roll as consumption, like people are consuming less, right? Rate hikes have an effect on people's behavior, but it will take some time to show up in CPI numbers. So I would say just be patient. The summer rally was on Fed misspeaking, talking about Fed funds being at kind of neutral levels, which they weren't. I don't think that's what Powell meant, but that's what investors took. And then you had a lot of technical analysis saying, oh, we were at these critical levels. Historically says every time we got there, the bear market's over. And that was really only half the story. And so people started buying the narrative in the market. And I think people are, it's the narratives that can kind of push you different ways, and that's usually what's the cause of bear market rallies. But I would wait for a bit of more of a washout in the kind of real economy before you get kind of excited about really pushing back into equity.
Could there be more bear traps awaiting us as we work our way through this?
So sometimes this profession, mentally, you feel like you're a bit of a kite in the storm, if you will. And so I was actually just looking at not to say this is the same, but to look at a previous bear market. I went through the 07, 09 experience. And within that bear market, there were a number of rallies, double digit, 15, 25% rallies before you ultimately hit the bottom. And I think you have to be very disciplined when you are looking for a degree of bottoming, in various other metrics to get comfortable that we are actually at the bottom, and that you've seen policy shift, right, and start to see where inflation is on a two-handle, and you're getting a feel that central banks are really looking to ease policy again. You'll see it in the bond market will start to steepen as the front end starts to rally. None of those things are happening yet, right? So again, I would say that rallies at this point forward with nothing else changing are bear traps.
All right, so that's a good piece of information to take away from the conversation. What's happening in Britain right now? You get a new prime minister, you get a new, our equivalent of finance minister was with the exchequer, right? And then and a pretty violent reaction in the markets to some of the plans that they have. Is this one of those, I mean, this is the G7 nation. Do we need to be concerned in North America about what effect it could have on our markets? Is this sort of a British problem with the problem at the moment?
This is I actually think that historically we'll look back at this period as one of those moments when the markets went on a completely different kind of direction and economies going in a completely different direction than what had previously been understood. And what I mean by that is the UK moved forward with a package of tax cuts funded by borrowing. Now, look, we all have our ideologies, and there is an ideology that smaller government, lower taxes, okay, but to pay for tax cuts, usually you shrink services. And there's an ideology where we're increase taxes and increase services. You may be on either side. But to go and cut taxes and then say we're going to finance it with debt at 4% and think that you're going to be able to spur growth is a very risky strategy. And what you saw was that you can't do that anymore because the marginal buyer of your bonds is not the central bank. It's investors. Investors are saying, right? So, and if you think about it, so for a household making $200,000, these tax cuts are about a $4,500 savings. Well, sterling's off 7% since it's announced. So you've already, that household, in terms of goods they buy, U.S. goods, they've already just lost $14,000, and borrowing rates are up about 70 to 80 basis points. So, epic fail, and I think it's a warning to other finance ministers that you got to keep in mind the reaction in the bond market to your policy, something you haven't really to worry about for years now. And I think this is going to really usher in a sea change in how governments think about, we have to start prioritizing and think about needs and wants and focus on those needs because the cost of money is materially higher than it was a year ago.
I mean, what we're living through right now, and so much has happened just in 2022 alone, but of course the greater context is the pandemic, the massive dislocations that we had across all sectors of the economy, had in the markets. It seems that we're going to be living with this hangover for a very long time.
Yeah, I mean, now we're going through kind of the longer term implications of COVID, long COVID, for certain, and even now, we've had just recently a bit of a surge here in Ontario, and you have absenteeism, shortage of labor, and an amazing amount of those 55 and over leaving the workforce. So we do have true labor shortages, and so we're still living with that. My sense is, though, that the behavior during the pandemic of kind of excessive consumption is now about to reverse. And that all what we're talking about today about supply chain challenges and goods consumption is about to reverse across the board. And so in many ways, it's going to be weird where you've got these very high borrowing costs, but I think prices of some goods is about to come down as retailers start discounting excessive inventories. But this is really a story that was going to kind of unfold over the next couple of quarters, I would believe.